The first tick is on the downside for the market, so down almost about 40 odd points.
Now we're at 17,550 in the red for the benchmark indices. We've lost about 50 points in the Nifty.
Nifty is down 120 points as we speak.
The final leg of a long drawn-out kind of day panning out, and we've had many legs. The latest, of course, is that there is a bounce, which has basically taken us back to 17,550 levels. Market closes with in the green, first of all. Second, with about a 60-odd point gain, 66 points to be precise. And three, it almost leaves off at the high point of the day, which was made earlier in the day as well, almost there.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track 6 hours of the trading action in just 5 headlines for you. I'm Rachel D'Souza. Let's get straight to the headlines for the day. Stock markets recover in the last start of trade to end in the green after a volatile session. The sensex gains over 150 points, the Nifty up close to 50 points, but the Midcap index ended in the red. The Adani stock rout extends for the third session, wiping out more than 5.5 lakh crore in market capitalization in 3 sessions. Adani Group CFO remains confident that the 20,000 crore follow-on issue will sail through despite the turbulence. Data patterns leaps after a strong third quarter sees profit as well as sales more than double. The management tells CNBC-TV18 they're targeting a 45% revenue growth with margins of around 40% in FY23. However, BEL slides on the back of a sharp dip in margins. L&T posts a muted quarter with net profit margins and EBITDA missing street estimates. Bajaj Finance perks up on reporting strong growth in credit, healthy asset quality and margins, while an all-round beat of expectations by NTPC charges up the stock. Laurus Labs closes flat after margins miss street estimates for the third quarter, while high fuel costs pulls Kajaria Ceramics 3% lower. Well, here's what we have lined up on the show for you. We bring you market opinion from Gautam Shah, founder and chief strategist at Goldilocks Premium Research, and the big corporate voice on the show, Jugesinder Singh, the group CFO at Adani Enterprises. Well, let's get straight to the market action of the day. Well, the markets recovered in the final hour of trade to end a little bit higher. The Nifty and the Sensex, well, they rose close to around 0.25% odd. In the broader markets, the Nifty Bank recovered 2.5% from the low point of the day to end mildly in the green. Meanwhile, Adani Group stocks have raised market capitalization of around 6 lakh crore in around 3 sessions. Prashant?
A day of immense volatility on the Nifty, the market seeing huge moves, wild swings in the first 1 hour of trade. Then there was a crack and the market traded down, firmly down for the next few hours. And in the last 45 minutes, 30 odd minutes on the Nifty and the Bank Nifty, there was a pullback and we ended in the green, both on the Nifty and the Bank Nifty. Adani stocks, I mean, really the center of all attention. Two separate kind of price action. The cash stocks, Adani Total Gas, Transmission, Adani Green, all down firmly lower, whereas other stocks like Adani Ports, Enterprises, Ambuja Cements, which are also part of the F&O list, they're seeing some positivity. The other sort of big Nifty movers on the upside and downside, Bajaj Finance reacting to numbers, Ultratech and Coal India, which were higher. And on the other side, Power Grid, JSW Steel, Bajaj, which has done well recently, coming under pressure. Broader markets, declines outnumber advances some 4:1. BEL, EID, Parry, Hindustan Zinc, BKG, Sharda Crop, etc. were those names. The Nifty and the Bank Nifty both have managed to defend near-term levels in terms of supports. It is 17,550 for the Nifty. It is 39,970 for the Bank Nifty. And we've closed above it, although, I mean, the price action today showed lack of any real confident kind of moves. So it still remains a little tentative. The market is slowly but surely getting into a bit of a oversold zone, at least in the very near term. And of course, the attention will be on the Adani Enterprises FPO, which closes tomorrow. And I think the performance there in terms of investor interest, etc., will be very, very keenly watched. Later in the week, of course, we get into the union budget and the Fed meeting. Back to you.
Thanks a lot for that, Prashant. Well, in market opinion, we have Gautam Shah, founder and chief strategist of Goldilocks Premium Research. He said he expects a move down to around 16,900 on the Nifty. That's if it drops below the 17,250 odd mark. Let's hear out what he had to tell us.
India has been one of the biggest underperformers in the last 6 weeks. So all of this just, alluded to weakness. It's already played out. And I think it's going to get worse before it gets better because there are no signs of bottoming out of the charts. And my numbers on the downside, I think for the very near term, 17,250 to 17,300. So that's where some of the technical studies have coincided to indicate some support, and you have the budget in a couple of days. So maybe the market finds some support there. But I think eventually the chances of a deeper cut is quite high. And on the upside, 17,800 and 18,050, till these numbers are not crossed, we would maintain our bearish stance.
Well, moving to the second headline now, the Adani Group stocks continue to remain under pressure for the third session in a row. The group has lost 5.5 lakh crore in terms of market capitalization after a report by US-based short seller Hindenburg raised several red flags. Although most of Adani Group stocks remained under pressure, Adani Enterprises, Adani Ports, ACC and Ambuja, both of them managed to buck the trend, clocking gains. The group has accused Hindenburg of securities fraud, calling the company Madoffs in Manhattan. Hindenburg hit back at Adani, saying the fraud cannot be obfuscated by nationalism. And as the war of words escalate, the 20,000 crore FPO from the Adani Group has completed 2 days. The overall subscription is just 2%. The QIB portion is yet to see major bids. HNI portion is subscribed by around 1%, retail at around 3%, and the employee portion has been subscribed by around 10%. The CFO of the group, though, remains confident that the FPO will sail through. Speaking to CNBC-TV18, he admitted there could be some pullback from retail investors, but he is confident of bids from institutional investors. He also said that the group's total debt is around $30 billion, of which $9 billion is owed to Indian banks. Let's hear him out.
We are confident that on the institutional side, that the entire issue is from based on our discussion, roadshow meetings, etc., will be fully subscribed. And that's why we clarified the rumors were going on. So we clarified on Saturday night that that the FPO will proceed on current pricing and on the current timelines. So we are supremely confident that from an institutional perspective, we are there. But there will be some pullback in the retail given such the pricing differential and the volatility. FPO will go ahead on the same conditions that we launched. Gross aggregate debt position in the group is just about 30 billion, of which $4 billion we hold in cash, approximately. Just under $4 billion we hold in cash. Because the way the domestic bank is, there was some sanction limit. So if I just go that on a sanction basis, it will be about 9 billion.
Well, meanwhile, index provider MSCI said it is seeking feedback on Adani Group and associated securities and is aware of the report issued by short seller Hindenburg Research. Vivek is with us to run us through some of those details. Vivek?
Well, another important angle to examine the volatility as far as Adani Group stock prices are concerned is the angle in which how will passive indices actually treat these stocks as far as both MSCI and FTSE is concerned. In fact, over the weekend, MSCI came out with a notification where they said that they are now looking at feedback from members and they would communicate further as more information is available as to how exactly they would treat Adani Group stocks that are in the MSCI Global Standard Index. Now remember, why is this important? All of the Adani Group stocks, barring Adani Wilmar, which is a recent listing, all of them are in the MSCI Global Standard Index. Now, as per Nuvama research, the cumulative weight of all of these stocks in the index is 5.75%, which works out to a little over $3.5 billion as far as the entire group stocks value as far as the MSCI index is concerned. Nuvama, in fact, has done a scenario analysis as to what exactly could be the various steps that MSCI could take as far as the treatment of Adani Group stocks are concerned. Now, the first thing that they say is that in case there is a ceasing as far as the stock price volatility is concerned, MSCI will choose not to take any action. In the scenario 2, what is it that they are mentioning? They are saying that in case the volatility continues, the index provider, that is MSCI, could exclude these stocks with a prior announcement made to the members. The third scenario is that, which something that we saw play out as far as Piramal Pharma is concerned, is that MSCI decides to remove the Adani Group stocks from the index. However, because some of the cash stocks could actually be hitting a lower circuit, the passive funds that actually track these particular index managers would be unable to exit their holdings. In that case, there is a possibility that the index provider can delete specific stocks at zero value as well. The fourth scenario is which where they do not completely delete the stocks, rather they reduce the weightage that these stocks enjoy within the MSCI Global Standard Index. So they could reduce the weightage by around half, that is 50% weight reduction, and that could lead to a cumulative outflow of a little over $1.5 billion.
Thanks a lot for that, Vivek. Well, moving to the third headline now. Defense stocks, they were in focus as Data Patterns and BEL, both of them reported their quarterly numbers. Vahista is with us to run us through a quick analysis on both those two. Vahista?
Well, I'm going to be talking about two defense stocks which released their results over the weekend. And the first is Bharat Electronics, which is a strong play in the ongoing defense indigenization theme within India. The revenues were bang on the CNBC-TV18 poll and came in at 4,100 crores. But what has been worrying the streets have been the margins, which have been coming much lower even than the estimates. The estimated were 21.9%, but the actuals have come in at 20.7%, which is anyways lower than the same quarter of last year, which was at 22.3%. So this is something that the street is fearing. Another point why the stock has been in red today is because of the order inflows, which have been low at 3,500 approximately for 9 months of the ongoing financial year versus what the management had guided to us earlier of 18 to 20,000 crores. So to reach that target by the end of FY23 means another 16,500 crores, which has to be achieved in Q4, which seems to be a hard ask. And hence, BEL has been in red today. But another stock, which I'm going to be talking about also from the defense space, has been Data Patterns, which released an exceptional performance in Q3 of FY23. In fact, the revenues have doubled on a quarterly basis. The revenues were up nearly 155%. The EBITDA margins have come in at 42%. And the bottom line grew by 267%. The company has also said there's a new manufacturing facility which is expected to commence in Q4 of the ongoing financial year. We also hosted the management on our channel today morning, and they have upped the revenue guidance to 40 to 45%. On a year-on-year basis, which is to be compared with the earlier guided of 25 to 30%, which means there is a strong show from this company. Back to you.
Thanks a lot for that, Vahista. Well, time to slip in a short break. We'll be back in a jiffy with the remainder of the headlines that we're tracking for you. Welcome back. You're still with us on Markets Today. Well, as promised, let's go through the remainder of the headlines that we're tracking to you, which brings us to the fourth headline for the day. It was a muted showing coming in from L&T, with the company's net profits, margins and EBITDA missing street estimates. Vivek is standing by to run us through a quick analysis on those numbers. Vivek?
Well, that's right. So, it's been a bit of a mixed quarter from L&T this time around. While the order inflow as well as the management commentary has been quite strong, it's been a miss on the margins due to rising raw material prices. And that is something that, could weigh down as far as L&T's, this particular Q3 announcement is concerned. Looking at the numbers, revenues are largely in line with our poll, coming in close to 46,390 crore mark, largely in line with our estimates, like I mentioned. However, the EBITDA has come in at a little over 5,070 crore, which has missed our estimate of close to 5,385 crore. Margins have dipped on a sequential basis, a 60 basis points dip, and profits too have missed our estimates marginally, coming in close to 2,550 crore mark. Now, what the management has said is that, margins have come under pressure on the back of continuing cost pressures. And another thing to keep an eye out for is the fact that PAT this time around included a one-time gain of 97 crores on back of the divestment of the mutual fund business. However, when you're talking about the management commentary, it's quite robust. They've actually shrugged off any recession concerns. They believe Indian economy will continue to do well, and they believe private capex will pick up, especially in the segments that they're present in, especially in the industrial segment. Overall, a mixed quarter with margins to miss. This is something that the street will look forward to quite closely.
Okay, all right. Thanks a lot for that, Vivek. Well, moving to another big name, Tech Mahindra. They reported their third quarter numbers, which were largely better than what the street was working with. The profit number came in at around 1,300 crores, which was on target. The dollar revenue came in at around $1.6 billion. That's marginally better than what we were estimating, while the dollar revenue growth was a little under 2% on a sequential basis. The margins came at around 12%, which was better than our poll, which projected margins of around 11.8% odd. But let's stick with big earnings for the day. Bajaj Finance and Bajaj Finance, both of them reported their performance for the quarter. Abhishek Kothari is standing by to give us a quick analysis on both of them. Abhishek?
Well, Bajaj Finance reported an inline set of numbers with our polls. To begin with, the new loans were at 78.5 lakh, up about 16% on a sequential basis. The AUM mix shows that there is slowdown in the mortgage business. However, consumer, SME and commercial business have driven the growth this time around. So calculation shows that the net interest margin might have improved on a sequential basis, but it has declined on a YOY basis. The asset quality that remains benign. Gross NPA ratio has declined by 3 basis point quarter on quarter, and restructured book also remains very good at just 0.08% of the total loans. So return ratios remain healthy. Both the ROA and ROE have improved YOY and quarter on quarter. In terms of PNL, the NII is a beat on our poll. However, the PAT is largely in line with our poll. Coming on to Bajaj Finserv, the insurance subsidiaries PATs have disappointed. So to begin with, general insurance, their profitability is down about 8.6% YOY and about 17.3% sequentially. The life insurance business that saw a PAT decline of 8% YOY and more than 49% sequentially. So in the life insurance business, the premium growth was strong quarter on quarter at about 8.5%. However, renewal premium was the highlight given the fact that it grew by more than 30% YOY and around 15.5% sequentially. In the general insurance, the premium grew by about 29% YOY. However, it declined by 20.1% quarter on quarter. The net earned premium declined by 2% quarter on quarter. That was a resultant over there. So general insurance saw an increase in the combined ratio, which is the operating efficiency, which declined on a YOY as well as sequential basis. Back to you.
All right. Thanks for that, Abhishek. Well, moving on to the fifth headline today, Kajaria Ceramics and cigarette maker Godfrey Phillips India, both of them have reported their numbers for the past quarter. Manglam is standing by to run us through a quick analysis on both those two numbers. Manglam.
But Kajaria Ceramics was under pressure in today's trading session, and that was largely on account of weakness in numbers. Just take a look at the numbers. I mean, a 2% jump in their overall revenues meant that the demand was measly on account of extended rains in October, at the same time the festive season. The company said that it recovered in November and December, but the street, would like to see some more recovery going ahead as well. 2% jump in their revenues was on the back of mostly price increases. The volumes dipped by about 1%, and higher prices of fuel and power meant that we saw a compression of almost 500 basis points on their margins, and as a result of which the net profit fell by 41%. On the other hand, for Godfrey Phillips, the revenues grew about 30-odd%. The net profit grew by 50+%. The reason why the net profits actually outperformed was because of a high other income component that the company reported, and that's because of gain on the sale of their chewing tobacco business. So 35 crores in terms of additional other income was recognized this time around. For them, the growth in their company was led by the tobacco and others division, whereas there was a widening of losses in their retail business. That's talked to in focus. The important trigger, however, for Godfrey Phillips will be what takes place in the budget in terms of an announcement coming in from the tobacco tax front.
Got that, Manglam. Thanks for that. Well, moving on to notable pharma earnings of the day. Laurus Labs, where it had an initial pop, but it cooled off from the day's high on the back of a miss on the margins front. Ekta standing by to run us through a quick analysis. Ekta?
Well, yes, for Laurus Labs, it was largely an inline set of numbers. Revenue was up around 50-odd%. Street was anticipating around a 47% growth. Profit of around 200-odd crores. Street was anticipating around 185 crores. So both these parameters were better or slightly better than expectations. Remember, numbers were also supported by a low base. But operationally, maybe there was a tad miss. So the margins came in at around 26.1%. Street was anticipating around 28%, and the margins were the lowest that we've seen since Q4 of FY22. Now, in terms of the fixed dose formulation segment, which is around 16% of their revenue, that declined on a year-on-year basis, but did see a sequential recovery. The other two segments, which is API as well as the CDMO synthesis business, both grew on a year-on-year basis, but there was some amount of sluggishness on a Q-on-Q basis. Now, in terms of FY23, the guidance is that the company will report a double-digit revenue growth. They've already done around 33% for the 9 months of FY23 and stable margins. But remember that in the previous quarter, they did mention that the margins could be around 30-odd%. This time, The margins for 9 months have come in at around 28%. So the street will watch whether or not there is any kind of improvement in the coming quarter. Remember, stock has already corrected significantly. It's down over 40% from its 52-week high.
Okay, thanks for that, Ekta. Well, on that note, though, we'll wrap up on this edition of Markets Today. Thanks so much for watching.